Welcome back to our intermediate financial accounting class. In our last few segments, we've been talking about taxes, and we've talked about lots of information on taxes, going beyond just a simple income tax payable and income tax expense to deferred taxes, NOLs, carry forwards, carry backs, temporary differences, permanent differences, how it shows up in the financial statements, all sorts of really cool stuff that are part of the reason why I'm a financial accountant and not a tax accountant. I'll be honest with you. I try really hard to remind myself that this is job security. But at the same time, the more I dig into taxes, the more I realize I like FASB and GAAP a lot more than the IRS and the tax code. But be that as it may, this is an important piece of doing our financial reporting, so we have to be comfortable with it, at least in the basics. And then we can get our tax department to feed us in the rest of the numbers. So the good news is you don't have to be an expert in tax, but you do need to know the basics so we can transfer it in. At the end of our last segment, we walked through all of year one for this comprehensive example. And I invited you to try year two before coming back to see how we do the calculation. So hopefully you've got your numbers ready and we can just walk through the process and you can see where your numbers maybe need to change, or if you've done it right, you can feel good that you just aced this and you've got it down. So let's go ahead and jump into it. We've got our numbers right up here on the screen. I'm not going to take a lot of time walking back through it, but make sure you're comfortable with these numbers and you've got them on hand as we jump over to Excel. For year two, I have created a template to walk us through our calculations. And we're going to start same $100,000 income before taxes. We've got the same $500 in life insurance premiums, but we have different adjustments for depreciation and warranty. And those are the only adjustments I have to worry about now because the revenue is not going to kick in until years 4 and 5. So I still just have these two, but I need to figure out what those two adjustments will be. And the best way to do that, as always, is to draw it. So let's jump back to PowerPoint where we can draw these numbers. So here's year two. And just like we've done in the past, we're going to start with GAAP. And GAAP, again, for depreciation, it's straight line, so it'll be $120,000 every year. In year two, the maker's depreciation is $228,000. So it is quite a bit lower. If I'm going to go from GAAP to tax, then my adjustment needs to be $108,000, and I'm going down, so it needs to be a negative. For the warranty, my GAAP number, again, is constant because I'm just estimating a set amount each period. So that's GAAP. For tax purposes, I actually paid out $19,000 for warranties. So that's the amount of tax break I can actually get. So to get from GAAP to tax, it's $1,000 and it's positive. So let's go ahead and put those numbers in. We've got a depreciation adjustment for negative $108,000 and a positive $1,000 for our warranty expense. Now wait, stop right there. Take a look at this number. Our taxable income is negative. If it's negative, then that means this is an NOL, and I get to account for an NOL. So the first thing I need to decide is, am I going to carry back or carry forward? And the best way to decide that is to take a look at our tax rates. So if we jump back to PowerPoint, we've got a 40% tax rate in year one, 38% in year two, and then it's going to go down to 36, 34, and then stay at 34. Looking at those tax rates, my best bet is to use that NOL as a carryback and get back the 40%. So that's what I'm going to do. So let's take a look at our taxable income from last year. It was $80,500. I've got an NOL of $6,500. I can't cover all of last year's taxable income, but I can cover $6,500 of it, which means I'm going to get a tax break, $6,500 times 40%. I use the 40% because that's what I paid last year, and that's the money that I'm asking the government to return. So I'm going to get a tax not payable this time, but receivable. Now, I would go back even further if I could, right? We talked about how you should go back not just 1 year, but 2 years. But last year was the first year of business, I can't go back 2 years because I didn't exist. So unfortunately, I'm kind of stuck. So I've got an NOL. Very exciting that we have this opportunity to play around with an NOL. It's almost like someone planned it that way so we could practice. That takes care of step 4. Moving into step 5, I'm only going to look at future years. Since I'm in year 2, the future years are now 3, 4, and 5. So I'm going to delete year 2. And I now want a net deferred tax amount of $41,140. It's negative, so it's a credit. So I'll come down here to my deferred tax T account. I want that $41,40 to be my balance in this current year, but I don't want it to be negative. I just want it to be a credit, so I'll make it equal to a negative. Click on that $41,400. I'm going to make it a permanent reference so that I can use it moving forward. If I want to go from $480 credit to $41,140, I need a journal entry for the difference. Now that I know my income tax receivable from step 4, and I know my deferred tax amount from step 6, I'm ready to do my journal entry. And I'm going to have to change quite a bit here. So let's start with what we know. We know we're getting income tax receivable for $2,600. And it's a receivable, so it shows up as negative up above, but that's just a debit into my receivable account because money's coming back to me. I know my deferred tax is $4,660. I can calculate income tax expense as the plug figure. So $4,660 minus the $260, that's my income tax expense for the period. And now that I know that number, I can fix my income statement. My current taxes are actually a positive $260 because I'm getting a refund. My deferred taxes are a negative $4,660 because they're a liability, and there is my income tax expense, and my net income would be $61,940. So even though I'm getting a refund, I'm actually showing less of a net income because of the large deferred tax liability that I'm having to record this period. Now, hopefully all of that made sense. We went through it kind of fast because I assumed that you'd done most of the calculations. But if you're comfortable with what we're doing, then please pause the video here for a minute, finish year 3 or tweak your year 3 if you've already done those calculations so that we can, again, talk about what you've already done instead of just looking at it cold turkey. Again, you learn better this way according to the research, so please give it a try. Now that you've had a chance to walk through the calculations, let's go through and review them. If you've got questions or concerns, please make sure you stop the video, go back and rewatch segments if you have to. Make sure you're comfortable with this. Hopefully, though, by this point, you're starting to feel really comfortable, especially if you're drawing those pictures. That really is the key to this whole thing. I know I've talked about it a lot. I just can't emphasize it enough that being able to draw that difference between GAAP and tax is what's going to make or break your ability to do deferred taxes, because you can see it and it starts to click and make sense. All right, let's jump through these numbers. Year 3, again, we've got a set amount of income before taxes, so it stays $100,000. Life insurance premiums haven't changed. Depreciation and warranty expense, still the only adjustments we need to look at because the rent revenue won't even happen until year 4. So we just need to look at those two. So let's, again, jump right to our PowerPoint so that we can draw our graphs. Okay, so we've got depreciation and warranty. Again, we're going to draw this out GAAP first. So depreciation for GAAP purposes still $120,000. For tax purposes, we're using those makers tables, and our depreciation under makers is $222. So to get from $120 to $222, I've got to drop again $102. So that's my adjustment for depreciation. For warranties, the gap is $20,000, and we actually paid out $20,000. So this is the exact same number. Because of that, the difference is 0. If the difference is 0, there's no adjustment that needs to be made in this current year. So let's go back to our Excel spreadsheet so we can do the calculations. Depreciation, we said, was going to be 102. And this year, we have 0 as our warranty expense. Now, a lot of times people look at that 0 and they say, oh, great, this isn't really an adjustment in step 3. If it's not an adjustment in step 3, I don't need a table in step 5. And if we're talking about something brand new, that's true. But if you're in the middle of reconciling a series of payments, so you've already got a difference that's occurred in past years and you're in the middle of getting towards the end of the timing difference, like we are here, you have to still keep that table there. So again, if this was a brand new issue and there was no difference between GAAP and tax, I'd leave it out. But because there has been a difference in the past and I haven't fully reconciled, I've got to keep that table there. Even though the amount isn't going to change, it needs to be part of my T account number. We'll show you that in just a second. So let's jump down here. Again, we have an NOL, $1,500. So I can use it as a carry back or a carry forward. I know that my tax rate was higher as a carry back. So if I've got any taxable income left from year 2 or year 1 that I can cover with this $1,500, I should do it. If we go back to year 2, well, we had a NOL in year 2, so there's no taxable income I can cover there. But since I'm in year 3, I can go back to year 1 still. Year 1 was originally $80,500. I've covered $6,500 of it, so I still have $74,000 of year 1 taxable income that I can cover. So I'm going to. So in year 3, move back over here, I'm going to continue to use that 40% tax rate because I'm trying to get refunded some of what I paid in year 1 taxes, so I use the year 1 tax rate. And that takes care of step 4. Now moving into step 5, again, I only want future years, which means this year 3 has got to go. Notice that the balance down here is a debit of $37.40. If I get rid of this year, it stays $37.40 because there was no difference there anyway. Again, I'll bring it back one more time. This was a 0, so it's not really factoring in. So I get rid of it. Doesn't really change anything, except I need this number to be part of my net deferred taxes. If I don't have it as part of my net deferred taxes, then this number is going to be wrong because I've been paying extra taxes in the past and I need to keep showing that as a deferred tax asset, offsetting the deferred tax liability up here for depreciation. If I get rid of it in the middle of reconciling between GAAP and tax, then I mess up my numbers. So please make sure that you don't just get rid of a table because it shows a 0. You can only get rid of it if it shows a 0 in step 3, if it's at the beginning or the end of the reconciliation period. If you're in the middle, you still got to leave that table in there. Let's see. We want to end with a credit of $77,860. So I'm going to put that down in my T account. Step 6, I'm going to calculate my adjusting entry. And this time I need a credit of $36,000. So I'm going to go ahead and put that in here. I know I've also got income tax receivable because in step 4, I said I was going to get money back from the government. And that leaves me with income tax expense as the difference between the two. So $36,120. Now that finishes up step 7, but I also want to look just briefly at what happens in the income statement. So let's see, my current is $600. My deferred taxes are a liability, so that increases my expense. And sure enough, there's my number again. I'm still getting hit with a relatively large income tax expense, even though I'm getting a tax refund. Now that takes care of years 1, 2, and 3. We have one more year that we want to look at, but we're going to end this segment and come back to it next time to wrap up our discussion of deferred taxes. We'll see you then.